Jared, welcome back to Your Wealth Playbook, the no bullshit guide to building wealth. Today, we're going to talk about investment companies, why it matters to you, what an actual investment company is, and how you can see the benefits and who it's actually for.
Kerrod, I reckon this is the biggest financial tool that people have and the biggest lever that they have to pull when it comes to their finances in terms of ways that they can plan out their tax, their income, their assets, their ability to borrow, and also their estate planning.
Jared, an investment company sounds a bit like a buzzword, but an investment company is a separate purpose vehicle which is established to own assets. Could be commercial property, could be residential property, any specific asset that you have, and this entity is created to have the ownership of it.
Now, when we talk about special purpose vehicles, why would you need one?
Why you would need one? Jared, the biggest benefit for an SPV is for a business owner and asset protection. If the trading business gets sued or goes under, the property inside the SPV isn't directly exposed. So therefore, because it's legally owned by a different entity, it's not under that same entity that's getting sued or is going under. It's quarantined away. It's a bit like bull riding, right? You've got the bull sitting inside a ringed fence because you don't want that bull bloody getting on the outside of that ring fence. It's a bit like your business. You want it sitting inside that ring. You don't want it coming out into the crowd. You don't want it going into anything else that you've got, especially this SPV. You've worked really hard to go and build wealth. You don't want it taken away from that bloody bull getting on the outside of the ring fence or your trading entity falling over.
So financing, my favorite. Lenders love a clean entity. You have a special purpose vehicle that is set up to buy a commercial asset, a residential asset, whatever it is that you're looking to invest in. You've got the ability to close that off and get an accountant letter to confirm that services itself. The income there meets its own commitments. Off you go on to the next one. This is a tool for building generational wealth. Now, it's a bit like a coal train. You just keep clipping carriages onto the back. You move on to the next one and to the next one. Seen those coal trains? They carry about 90 carriages.
Perfect. I have seen the coal trains, mate. Yes, I live in Singleton. And that's what you're talking about with the borrowing capacity. Once it services itself, you can keep your borrowing capacity, clip another train or clip another carriage onto the back of your train, and all of a sudden, your one train's carrying 90 carriages or 90 properties. Jesus Christ.
In an SPV, that might be a little bit less. It might be 900, it might be $1 million. But you've then got the ability to continue that on and on to then build generational wealth.
And so my favorite one, Jared, is tax planning. The biggest benefit that you can get from an investment company, especially if you're a business owner or you're a high income earner, is the tax planning side of it. Because you don't need to derive any income just yet, but you've got the ability, because it's in a separate entity, to derive that income whenever you like. It might be in 15 years or 20 years down the track when you're no longer in business or you're no longer working your high income job. You can have that income at any stage, or you can distribute that income to others. It could be family members. It could be to your wife if she's in a lower tax bracket, but you've got the flexibility and ability to go and do that. It's a bit like your dinner getting cooked up at home. Usually myself gets the largest portion, but the kids get a smaller portion, and my wife gets a smaller portion as well, naturally, because she eats smaller than me. But it can be the same for your income, and you've got the ability to distribute that. If you've got those assets in your own personal name, you've got no flexibility for your income and your expenses. You do inside an SPV.
The last one that will split up into two is probably defined by either a completed project that's deriving rental straight away or a project that you're about to get out of the dirt. So if we look at partnership clarity, you, maybe 2 or 3 other people want to buy a big commercial asset that's $3 million that none of you individually have the ability to jump onto. You pull your money, you go in, you buy that asset, it's getting you a 9% net yield. This is retirement come early.
If you're a builder, a bricklayer, electrician and a plumber, and you've all got a cracking idea that you want to go and develop a site, develop a house, or develop a commercial real estate, develop a little bit of land, you can do that and you all put in equal amounts of money. Let's call it $100,000 to go and buy the block of land, but you're all going to equally put into it. The partnership clarity that you get from an SPV is that you understand who owns it, at what percentages, and when there is a dividend or a final divvy up of the proceeds, there's no grey areas around who gets what. Partnership clarity sets it in stone how this income and the profits are going to be distributed.
Finish off the project, get out of it, distribute your profit, and then move on to the next one.
We've gone through why an SPV matters for high net worth individuals or for business owners, but how an SPV can actually benefit these type of clients is it lowers the tax on the investment income. Because if you're in the highest marginal tax bracket, you're going to be paying 47 cents on the dollar on any additional income. If you've gone and built a commercial asset that puts $100,000 worth of income because it's got a cracking rental yield and there's not much debt in there, you're going to lose 47% of that. Whereas if it's inside an SPV, you're only going to pay tax at the highest marginal tax rate for an investment company, which is 30 cents in the dollar. The last time I checked, Jared, 30 is below 47, so therefore you're paying less tax. But another big kicker that you get is a franking credit. And a lot of people don't really understand what a franking credit is, and a lot of people hate paying tax. Yes, in your personal name, paying tax, you've got no ability to get that money back. But inside an investment company, when you pay the tax, you get a franking credit. So when you end up distributing that income, you get that tax back. Because a beautiful thing in Australia is you only pay tax once. Paul Keating, under the Hawke government in 1985, created the imputation tax credit system, meaning that you only pay tax once. So if you own that company and it is paid tax, and then now it distributes that income to you, you get that income plus a franking credit.
Now, less income tax here is great because that allows us to retain more of our hard-earned profit and invest it into the next asset and wealth building tool, whether that's into some more shares, whether that's into another property, a commercial or residential, or potentially using that income because it is meeting its own commitments into borrowing capacity on the next one if it's deriving an income stream for you. And that's where it becomes really powerful, and I've got the ability to compound into the next carriage.
$70,000 compared to $53,000 in the scenario that we're using, Jared, because of the tax. If you reinvested that at an average of 8%, over a 10-year period, it works out to be $250,000 more by having the right structures through an SPV. That's a massive benefit if you can understand what you're doing and get the right structures in place for you. And Jared, I think that's why you and I are so passionate about talking through an investment company, and why you mentioned at the start that this is probably a very underutilized tool for these individuals looking to build wealth, because of the compounding over a 10-year time period is massive.
And that's spot on. You have a look at this and people might be looking at their fortnightly pay slip and the difference in tax there, or on a month or a quarter basis. But if you take a step back here and you're having a look at, first of all, on an annual basis, what you're saving, but then what you can save over a 10-year period, these are the big things that make it an enormous difference to people's ability to generate wealth.
And create generational wealth.
Now, generational wealth, how do SPVs here get used to pass property down from generation to generation?
If you're passing property naturally, if it's held in your personal name, it has to change with the land registry, whether that be New South Wales, Victoria, Queensland, wherever that property is held. You have to change the name if someone is deceased or passed away. Not a nice topic to talk about. However, if an SPV holds that property, and we're talking about property specific here, you just have to change the director. And that's it. It's a form to ASIC that you fill out. That company still holds the property. It doesn't change hands. You don't have to pay capital gains tax again. You don't have to pay capital gains tax. You don't have to pay any stamp duty. You don't have to go through all of those different things when it transfers, but down the generational line to your family members. You've just got to change the directorship of who the actual director and owner of that company is that owns the property. So from a tax planning and estate planning point of view, it can really expedite the generational wealth for your family, because Now, your dependents don't have a large tax bill when you're not here. What a win.
Truly understanding how these SPVs work and how they benefit business owners and high net wealth individuals is paramount when it comes to planning for building that generational wealth, isn't it?
Exactly that. It's a massive compounding advantage that you can get, obviously, if you understand the right structures, get the right vehicles in place, but more importantly, have the right team. So if you are considering being a property investor and you're a business owner and a high net wealth individual, go and sit down with somebody that understands exactly what you're trying to do, because they can point you in the right direction. And it might cost you a little bit more now for the setup, but the amount of money that you're going to get back on tax, the amount of carriages that you can clip back onto your locomotive and train, and the less tax that your family is going to pay if it is a generational asset, I don't mind paying the couple of $1,000s to set it up with an accountant now, because the benefits far outweigh the cost.
I think that's something super important that people do understand, because a lot of people that we do come across, they've had advice from people that shouldn't be giving them advice in the first place. And it is about cost, and cost is an objective in setting it up. But until you can truly understand how these assets work, how the income flow works, and what the saving compounded over a long period of time, to set up an SPV and to pay a little bit more to your accountant each year to do a return on another entity versus the savings that you'll get, again, year 1, year 2, maybe not a lot. You may be buying properties that are running at a loss to start off with. But as time goes by, that asset goes up in value, the income goes up in value, and the debt that you're potentially taking out goes down in value. That's where these structures are going to come into their own in year 5, year 6, year 7. So we're not saying that any of this is a quick fix, and we're not saying you're going to go and buy an asset tomorrow that is going to give you $100,000 worth of net income. If you do, please tip us in. We'd love to be shareholders and use one of these partnership agreements.
But it's looking long, playing short. What's the long term for us? Because we're always looking in decades, never in years. Especially if you're building generational wealth for you and your family. That's not in a couple of years. That's in decades. So get it set up right. Otherwise, it is going to cost you a hell of a lot more money in decades to set it up when you should have set it up today.
When you've got a capital gain to transfer it into an entity and hundreds of thousands of dollars worth of bills, stamp duty on the asset again, getting it right the first time and paying that little bit more for the setup and potentially being a little bit slower on the setup as well versus going and just exchanging on something in your personal name because you think that's what you should do and that's where you own property. Understanding how the back end works is paramount.
If that asset is over $2 million, I would seriously be considering an SPV. Now, that's not a hard rule, but over a decade, that $2 million asset is going to be more than $2 million. And if you're going to have to pay stamp duty or capital gains tax on something like that, those bills are massive. So if you've got a high value asset, please consider different structures that may be available.
Hopefully you've learned a little bit today about the power of this over time and the compound effect that this has in your ability not only to plan for asset building and intergenerational wealth, but also the tax planning that comes with it.
That's a wrap for investment companies, why it matters to certain individuals, how they can benefit from them, and what an SPV actually is. Thanks for tuning in to another episode of Your Wealth Playbook. If you could help us out in any way, the biggest benefit that Jared and I, and also Danny, will get is if you can subscribe to this podcast on your favorite platform and maybe share it. Send it to somebody that will benefit. You'll help us. If you'd like to help us, we'd love for you to help us.
The information in this podcast is general and does not consider your personal objectives, financial situation, or needs. Before making financial decisions, consider whether it is appropriate for you and seek professional advice. Past performance is not a reliable indicator of future results. If you would like to discuss today's topic further, reach out and we would love to help.
Jared and I have not assessed your individual circumstances. Therefore, this podcast is general in nature and for informational purposes only. This is not personal financial advice. There are so many advisors and brokers in Australia. You'll find one that you resonate with, but this is for informational purposes only. Or maybe just use Jared and I.